That's on you. What is it doing? Going live?
Yeah.
No, I'm just joking.
You're live.
I'm live.
I'm just joking.
So I'm gonna let everybody log on, give a few seconds, and I'm here. So, hey Mari. So this is stocks for beginners. If you're an advanced person, if you do any type of major stock trading, advanced trading, this is definitely not for you. Hey, Crystal. Tell the family I say hey. So this is definitely not for you if you do advanced trading or anything like that. This is not talking about option trading or anything like that. This is just for beginners. Last week I gave you the introduction to what stock is, and actually it became more popular than what I thought it was going to be because I got a lot of inboxes, a lot of questions. So if you have questions here, you have the opportunity to ask me. Hey, Ashley. So what I'm going to do now is you'll be able to ask me more questions. So hopefully you looked at my original video, and then looking at my original video, you can take that off the charger until you need it. Looking at my original video, you may have more questions than you would have had before. So today is the day to ask those questions. So I'm giving you what I would say the basics of what you need to learn how to do stocks up on your own. And once you have the basics of what you need, then you can do the research. You can ask more questions. You can even go seek a stock professional. But you can also Google. You know what to Google now. You know what to look for now. You know what you're looking at with the numbers. So that's what we're going to do today. So while everybody is logging on a little bit more, I'm going to be doing some basic stuff. Now, the first and number one question everybody asks me, if I am broke, how do I get into this? Based upon what I said last week, if I'm broke. Now, I made a mistake and I looked at the last video and I said something about E-Trade or one of these companies will charge you to $500 to get started. And really what I meant was they allow like $500 to get funded. I shouldn't have used the word charge. I should have used the word funded. It is your money. It's not anybody else's money. So what you want to look for first, let me just piggybacking from the other part one video, is you want to make sure what is the fees per trade, sometimes known as commission. And so when they say per trade, essentially what they mean is per trade means this. So let's just take I'll take this first stock I gave you guys to link up is Coca-Cola. That stock tip on the pictures if you see is here. You can't see it here, but it's CO. Coca-Cola stock symbol is CO. So if you're looking at CO and I want to trade or buy, and a trade is when you either buy or sell. So to get to be an owner of Coca-Cola is you want to buy or sell a share. That is called a trade. You're trading with other vendors to either buy or sell per trade. So buy or sell, that's what we mean by trade. So when you're looking at the commission cost of your particular brokerage company, whether it's Robinhood app, whether it's E-Trade, Charles Schwab, Merrill Lynch, whatever you use, it really doesn't matter. I'm not here to promote any particular vendors. They ain't giving me no money, so I don't care. So I'm here to inform you. So the real question is, what are you looking for? So if you're looking for the per trade, so that means if I bought 100 shares of a particular stock, it's at that time it's one trade. So it could be 100 shares, it can be 1,000 shares, or it can be 10,000 shares. And some places will charge you $0. Some places will charge you $5 or $4.95, whatever it is. So that is a per trade cost, even if it's just one stock. If it's one share, it may cost you still $4.95 or $0. So when you're looking at which of the trading brokerage account companies cost you whatever they cost you, that's what you want to look at. What is their per commission fee? What is their per trade fee? What is their commission fee? That's what they get to make money. Sometimes they just want your money to invest other ways, so they won't charge you a fee. So that has nothing to do with the stock itself. That has everything to do with the brokerage company when you're actually beginning to purchase. So when you're funding the account, you want to make sure, because if I'm telling you to buy 25 stock in something, I don't want all your money to go to brokerage fees, because you can see if I'm telling you to buy stock $25, or I'm sorry, $250 worth of stock, and you got to pay what, $5? What's that, 1% or something like that? You don't need those extra fees. So the closer to zero per trade fee you have, the better for you. And that means you can, trade and buy and sell lower stock, and your money becomes more effective. So just take a minute and think about that, and that's all you really got to know about the commission fees. Okay? All right. So now that we got that out of the way, the next issue is, what am I looking at in buying or selling stock? So this is the next item on the list. And if you printed out or looked at or tapped on the link I sent earlier, and you'll have this one of Coca-Cola Company. Now, is there a reason I chose Coca-Cola? Nope. I just picked one because it's a big corporation. And then the big corporations, usually what you'll have more than anything else is you'll have a lot of more information regarding the stocks and things like that. How do I make money? Knowing how do I make money, there's some things I want to show you. Now, remember last week I told you that there were two types of stocks. There is short term, and then there's long term. Now these are, I'm sorry, not type of stocks, two type of investment. Short term is usually when we talk about 1 day trading, or anything under, I believe it's a year. I don't know anything about taxes, so verify that for me. Short term, I believe it's anything under 1 year, and anything over 1 year is considered long term. And these have different tax rates. And the best way I can explain it without getting deep, because I'm not a tax person, Google that if you need to. But a short term essentially means if I went out and I went and made $300 today, the government is going to tax me my regular income like paychecks. So that's what you call capital gains. if I went out and I waited and made those $300 on the stock that I purchased and it was more than a year that I held that stock, I'm going to get a lower tax rate. So short term, anything under a year, which means whatever amount of money. So I go out, like I said, I went out today, I had $1,000 and I went and made a $300 profit on that $1,000. And then now I have $1,300. When I report to the government my earnings, or when you get your statement from whatever brokerage to say you made $300, they're going to tax you like they normally would tax you on any income an entrepreneur would make, or you pay on your work taxes or whatever at the end of the year. That is called short-term income. It's just, you flip money. Now, again, this profit in the stock world or tax world is called capital gains. Now, there are a lot of different types of capital gains and the tax ramifications. Again, I'm not getting too deep in that. So, but when you Google and want to know how you're being taxed, this will give you a good word and terms to look for: capital gain, short-term profits or stocks, and they're going to tax you on the $300 because this is your profit. Now, I'm going to just give you an example. I have no idea what the numbers are, but just an example. This tax rate on this $300 profit may be 20 to 25%. All right? Long-term gain may be different. This is when you talk about certain big businesses made how much amount of money, but they didn't pay that much in taxes. That's because they held their stock or capital gains for over a particular year, which then goes, same $1,000, $300 in profit, and now that same $1,300. So this tax rate may be 10%. 10 to 15%. And again, this is just an example of a different tax rate. So your tax rate here, and I have no idea what the tax rates are. So where your short term, the tax rate maybe 25 off that percentage. This is how they tax day traders. They don't encourage day traders. They want your money to be in the stock market. So they separate the day traders versus the long-term traders by giving them a different tax rate. So when you're in the market or when you're getting your taxes at the end of the year, you're going to understand why. This is the guy trying to flip it. This is the person who's letting his stuff sit in the brokerage or retirement account or being invested in any type of big company. So your tax rate is larger, even though you've made technically the same amount of money. All right, so that's about 5 seconds to soak that in. And again, it's called capital gains. So if you want to read up on that, look at the difference between long-term and short-term investing. All right. Now, before I get deep into this right here, the third thing I want to talk about is how to take control and save up a little bit of money to invest. So, again, you remember the story that I told you last time, which is I had some money, I came up with some money, and nobody wanted to help me invest because I didn't have $10,000, $15,000, $20,000 or $25,000. So the question was, how do I get into it? So what I originally did was I started to put a little bit of money aside. I found a brokerage account at the time. E-Trade was saying you only need $500 to invest in a brokerage account, and you only need $25 to invest in a Roth IRA. So the Roth IRA, and I think that stands for investment retirement account, they only require $25 at the time. I think now they may require zero and allow you to open up the account and then fund it like 25 or whatever dollars a week. So the Roth IRA started at 25 when I did it. So I had $25. I wasn't that broke. In the brokerage account, started at $500. Right? So at the time, I also had $500. So funding it really wasn't that big of an issue for me when I first started. It was knowing what to do and knowing what to put in it. So just with $525, I was able to start off. Now, from what I'm understanding, because everybody's trying to get into investment, you'll find a lot of brokerage houses, like the ones I mentioned earlier, who'll start you off with $0 and then give you a certain amount of time to quote unquote invest in the market, or to fund your stock, put your money in the market. So they'll start you off with $0 that way to get you, and then they'll allow you to put the money in later. Now, the only difference between a brokerage account and an IRA account is this is strictly a retirement account. Now, if you want to know more about Roth IRA, Google. Google is your friend, or YouTube, or somebody else. I'm just letting you know this is a retirement account. So the difference between my investment strategy in a Roth IRA and my investment strategy in a brokerage account is this: is I'm thinking long term for 95% of the stuff I put in here. I'm thinking long term and short term for the things I put in here. What does that mean? That means on a Roth IRA, I want things that I can let build up over time. I want my brick to eventually build up to a wall or a house or a castle. So if I'm 18 and just let it sit in over X amount of years, it's going to build up. If I'm 60 and this is my first day, I'll push the limits, because the 60-year is going to have more money to put in. There's an annual cap on how much money you can put into the Roth IRA, but your brokerage company will tell you that. You don't have to figure that out. They'll tell you what the cap is. It's going to be something like $5,000 or whatever the situation is at the time. Now, that's annually. I'm sorry. So here's what I want with this. So my Roth IRA, what type of companies do I want to put into the Roth? I want to put in the Coca-Colas of the world. Now, I won't put their stocks in, but I'm going to put their names. You don't have to. I want to put in the Coca-Colas of the world. Now, let me reference this. Just because I'm naming a company doesn't mean necessarily I'm telling you to invest in this company. I'm just giving you an example because we're all familiar with the name. So if that company goes under tomorrow, it ain't my fault. It's, you should have did your research. But you'll get the concept. So I'm going to say Coca-Cola. I'm sorry. Coca-Cola. Delta. Who? Oh, yeah. MRO. This is actually one I do suggest. Kroger. Man, notice I'm not saying Walmart, Amazon, and things like that. Do I think they'll be here 5, 10 years from now? Yes, but you don't have $1,000 to buy Amazon stock, so I'm not including that. We'll deal with that later. So the Coca-Colas of the world, or any big corporation that you believe over a long period of time will be there. Ford, or whatever, name a big corporation. And the reason why is over time, you believe that these corporations will weather the storm. Pepsi, that's their official name. You believe over time that these corporations will weather whatever storm it is. And so you're trusting that your investment in these corporations will, you know, over time, if I'm putting my money in for retirement for the Roth IRA, well, guess what? I need this money to be there 5 or 10 years from now. But here's the thing. What happens if this Coca-Cola all of a sudden, you wake up in the morning and they announce some type of crazy scandal and Coca-Cola is about to fall? Well, guess what? Because now you're controlling your investment versus somebody else who's controlling your 401k at school, or not at school, I'm sorry, at work or whatever. Now you can take your Coca-Cola stock and what? And sell it. Instead of waiting for somebody at um, instead of waiting for somebody at your brokerage company or your work to tell you your 401k dip 30, 40, 50%, you can say, look, I'm getting out of this Coca-Cola stock. What did we hear on the news or something like Warren Buffett sold all of his airline stock before? That's what you want to do. You want to see the skies falling or everything's this car's about to run off the cliff. Let me get rid of that. You want to have control. So you having your own stock allows you to do that. If there's any questions, y'all feel free to ask them in the comment section because I don't know what you guys are thinking at home. So, but because you have your own abilities in the Roth IRA for retirement, and a company, let's say like Toys R Us goes bust, or even JCPenney's when it was at its prime, you don't want the company to be stuck in your portfolio and all of a sudden your gains over the years of buying these stock, you're screwed because you saw the writing on the wall a long time ago. You want to be able to have control to get rid of that company. Also, when these gas companies right now, understanding the world and the gas companies are basically tanking, or the airline companies are tanking, well, if you knew or thought about the coronavirus coming, if you just was aware of Delta and you had it stopped a few months ago in January, and you knew this was coming, you'll be able to dump the stock too. You'll be able to keep that cash that you had gained. You don't have to let it go. So that's what you want when you work with your Roth IRA companies, the long-term companies. And we'll get into the reasons why when we explain what stocks are. The brokerage account companies, I messed that up. The brokerage account companies are essentially, think of the brokerage account more like a grocery store or a flea market. You can have so many different accounts in here. You can have what they call mutual funds. You can have ETFs. You can have bonds, stocks, hundreds of other different types of investments. These are just the ones you hear on the news every day, but the reality is you can have a lot of stuff. The difference between brokerage and the Roth IRA is the government only allows you to get back in hard times. Let's say if it's hard times, without penalty. If I put in, let's say over 10 years, if I put in $10,000, but my money and profit was $30,000, I had a total of $40,000 in a Roth IRA. I can get this money back without penalty from the Roth IRA because essentially it's my principal money that I actually cash put in. This is the profit. So if this is the profit, if I take this out because times are just hard, then at this point I'm going to be either penalized or heavily taxed. Now, this is just a general rule, so if things change tomorrow, again, do your research. I'm just letting you know what to be able to research. So you'll be heavily taxed upon the profits. Let's call this what it is. And a little bit more, you'll be taxed a lot more on the profits here than you would be here, because this account is designed for retirement purposes. But you can always pull your principal out without penalty, because this is the actual money that you put in. So the retirement account, they hit you a little bit harder on the taxes, even more than the brokerage account, simply because they want you to leave that money in. That's the whole purpose. All right? Now, you can have a lot of things in this retirement account, like you can in the brokerage account, but again, they want you to keep this in long term. So for me, to avoid all of that, right now, where you don't know anything, where you're really just kind of new to the entire system, the issue, hold on for a second, I'm sorry. Yeah, I'm gonna save this video so you don't have to worry about it. I'll save it as long as Facebook don't delete it. And will I explain the difference between mutual funds, ETFs, stocks? I will. No, I've not talked, no, Kayla, I've not talked to the difference between the dividends. So I'll deal with that. So I'll explain the difference with this later. All right, so long story short, when I'm thinking, again, putting stocks or whatever I'm buying, any of these in my Roth IRA, I'm thinking longevity, 5, 10, 15 years in theory. Hopefully that company stays afloat, but we see companies rise and fall at the same time. The difference is longevity. So Roth IRA, retirement, longevity. That's all you have to think of. But again, here, the 40,000, out of this, 10,000 is principal, so you'll be able to take that out if times get hard. It's a little bit tougher too. You got to go through a little bit of channels, wait a little longer to get your money than you will in a brokerage account. And so most of the time I tell people to just when you're doing this is strictly for retirement. So if you are in this for retirement, Google, find out more information about Roth IRA. The difference in between these and what you hear in your 401k and all that stuff is you're in control. So I'm not telling you to stop your 401k. Let the people that do the 401k, let them do what they do. I am telling you to create a Roth IRA for yourself or brokerage account for yourself in addition to doing that. All right? So now let's go back to the brokerage account and all of that stuff that's in it. So the rules that I'm telling you about the stocks and things like that are pretty much you can do with Roth and IRA. Roth and brokerage. So it really doesn't matter. Which one? Now the difference in brokerage account, like I mentioned, with the Roth IRA, is the brokerage account you can do what is called day trading. Now, I am not a day trader. I'm not a day trader at all. I will, however, make a profit and run. It's a big difference. So if I put my $1,000 in, hold on. I'm sorry. Well, here's the thing about somebody talked about the Roth IRA and the brokerage account. I'm not getting into the deep of that. I'm just explaining the basics. So yes, I do have a Roth IRA and my brokerage account, and you can have a Roth IRA in the brokerage account. That is correct. But in the beginning stage, I don't really want to get into the depth of the technicalities of a lot of stuff because they can't talk to their stock brokers or their brokerage company about that. I just want to be informed about the basics of it. So I don't really want to get into, they can talk to you to the technical people about it. All right. So that being said, though, you're correct. Now, all right. So with a brokerage account, what you really want to think about, this is where the day traders hang out at. Okay. Now, again, I'm not a day trader. I don't encourage day trading because it, we have to remember, stocks are akin to gambling. At the end of the day, it is 100% speculation. There are people in the stock market. There are people on Wall Street with computers and things like that that are so close to Wall Street. They're doing these things by the second, and I don't want you to try to outthink a computer. Sometimes when you're in day trading, you try to outthink a computer and you end up saying, oh, this stock looks hot. You put in your $5,000 and the computer update and your 5,000 just gone because you're thinking that you was going to make a lot of money. And I've seen it happen plenty of times, and so that's not what I really want you to think about. I really want you to understand where the stock is going maybe a year from now, maybe 2 years from now. And just so happens, if you put your money in and it duplicates, now you at least know how to, now it at least makes a profit and you know what's going on. So we're going to look at this sheet, the image that I told you to download on the other link. If you have not seen that link, go to my other link and then click back here. And that is for Coca-Cola. Now, here's some things I want you to pay attention to. Today, Coca-Cola is at $46. Now I'm gonna round these things up because I don't want to be dealing with decimals. So it's 46.21, but I'm gonna just round it up to 46. Again, I don't want to deal with a lot of decimals. Now what happens is every day stocks go up and stocks go down every day. So if you look at this document right here, they are based on what we call volume. The volume for Coca-Cola is this means that these Coca-Cola had on this particular day, and this changes daily. On this particular day, 22,737 trades or whatever throughout the day. Now that volume changes all of the time. It changes daily, and sometimes it can be lower. Normally big corporations will have more volume because of the nature of the beast. Smaller corporations may have, you may log in, sometimes it has 300 shares. That's when the stock kind of just sits steady. Now, volume is good because volume lets you know that it controls the price here. Supply and demand. If people are selling, the price is going to go down. If you notice in one of the documents, you'll see something called the 52-week range. And then the 52-week range in the document right here for Coca-Cola, the high today was on Friday was 45.60. I'm sorry, I did it wrong. I don't know where I got that number from. Oh, it opened at 6:21. That's what it was. Just make that $45 just for round numbers. Just for round numbers, I'm making it $45, but it was 46.60. All right, so the week range, which is right here on the document, which is right here, it's called 52-week range. That lets you know the highest and the lowest throughout the last year. All right. So that being said, the high is with the volume, depending on the volume of the amount of people, buying and selling. If more people buy, the price of the stock is going to go up. Well, what happens if more people sell? If more people are getting rid of their stock, the price of the volume goes down. This is the 52-week range. This is the actual 52-week range based upon this number on the document I showed you. So in the last year, the lowest Coca-Cola was 36, the high was 45. Now, that being said, that's important because it also gives you a good range, at least within the last year, of where the stock is going. That way, if you're looking at it, you can tell if you're on the bottom end, if you're on the top end. It does not mean that this is the lowest Coca-Cola will ever go. It does not mean that this is the highest Coca-Cola will ever go. It just means within the last year, this is what's been happening. Now, you have to take in consideration what has been happening in the last year. We don't know. So this happened in March. We know the corona hit in March, and it affected a lot of stocks. So the market dropped. It almost affected most stocks. But when everything started to get back to normal, guess what? We know everything, which is for today, it's starting to go back to where it was. But look at where it was if you look at this additional document. The 52-week range, a month before the corona hit, was the high was $60. So that means, in theory, Coca-Cola stock dropped 50%. So in here, March 23rd, the low, it dropped to $36. But a month earlier, it was at 60. So today, in June, it's at 45. So it's making its way back as society starts to go out, consume more. But think about what happens when society goes out and consume more. You have, hold on for a second. You have people, you have restaurants that are buying Coca-Cola. You have more stores, grocery stores that are buying Coca-Cola. People are going out. Probably when the corona was in and the quarantine was in, you're staying home. You made limited runs to the store. You made, restaurants wasn't ordering as much product. So now they are. Airlines flying, the airline giving you Coca-Cola or drinks. So all of these entities, half of them are still closed, but a lot of them are open, and the stocks are going back up because the speculation is that hopefully it'll get back here. It is speculation, so people are investing. All right? So I'll leave a couple of seconds. If you have any questions on this, now's the time. If not, I'll move on. All right. So now, with the Coca-Cola stock, I want you to look at the bottom number. This area right here is, we're going to talk about something called dividends and the payout. This is how you make money if you purchase a large company's stock. The best way I like to explain it is, smaller companies move like a speedboat. Higher risk, higher reward. Larger companies move like a cruise ship. They're usually a lot more stable, and thus the risk is less, but the payout over a long time is a little bit better, and it's a lot stronger. So, Coca-Cola, again, is one of those stocks I may have in my Roth IRA, just because of what is called the dividends. So, now, here, again, we are talking about Coca-Cola. Oh, I'm sorry. This thing is called a stock symbol. So if you see KO, that's Coca-Cola's stock symbol. And they're listed on what is known as the New York Stock Exchange. All right? So also, a dividend. What is a dividend? Dividend is essentially what you make when you are a shareholder of the company, and you become a shareholder by purchasing stock. So the more the more stocks you own, the larger ownership you have, whether it's 100, 100,000, or 1,000. So the more stocks you have, 100, 1,000, 100,000, the more of a shareholder, the more votes you have. Believe it or not, you also get to vote on what Coca-Cola does. So now, what we're going to look at, Coca-Cola pays, if you look at the document I gave you, in the dividend section, Coca-Cola pays 41 cents per quarter. Right? So this means if I have 100 stocks, every quarter, they should be paying me $41. Is that right? Yeah. So every quarter, they should be paying me, I'm sorry, $41 in what we call dividends. All right? So now, but if Coca-Cola is at, what do we say it was today? So if I have 45, all right, so 100 stock in Coca-Cola is going to cost me, let's see, let me redo this. So me buying 100 stock in Coca-Cola, no, you guys are broke, so let me refresh that. You guys, I want to buy 10 stock in Coca-Cola. So if I buy 10 stock in Coca-Cola, that's going to cost me $460, right? Now this is where my $500 I want to go. I want to go in Coca-Cola. So each quarter, I'm going to look at this as my, especially in my Roth IRA, but even in my brokerage account, I'm going to say, okay, what is the dividends as me being an owner? My investment in my $400.50 investment in Coca-Cola, I'm going to buy on Monday. So every 3 months, I'm supposed to get, according to this. Now, the dividends will change, but they can be reported for past results. So the dividends doesn't necessarily mean that this is what you're going to get for the life of Coca-Cola. It just means that at the time, as long as the profitability stays the same, that you will be able to get this amount of money. All right? So, at 41 cents is the dividend yield, or the quarterly dividends. We'll say quarterly dividends. Now, so 10, my 10 stock times 41 cents is so every quarter I'm going to get $4.56. Multiply that times a year. So every year, my 10 stock will yield me $18.24, right? So Coca-Cola essentially will pay me annually assuming this stays the same, but it does change, will pay me annually $18.24 for my share in being a Coca-Cola stockholder. Now remember, I am still a stockholder, so I can still buy and sell this stock. I can buy and sell these 10 shares should this 45 value go up. Because maybe I don't want to keep Coca-Cola for a year. Hold on for a second. So maybe I don't want to keep Coca-Cola for a year. So what I want to do is I want to be able to, I can be able to sell this. So we're going to take this. I'm going to take this, look at this. So my value goes up. Let's say it goes from 45 to 60 like I had before. And then I just want to be able to sell that. So then this $10 is now worth, I'm sorry, this 10 shares is now worth, so it went from 456 to 600, and I want to sell it at 600. This is so you can have the value go up, or you can keep the dividends if you want to stay in longer. But remember, this is for the beginners. So the beginning, for beginners, you're just increasing your value. So if you want to stay in, you worry about the dividends. If you want to stay out, you say, okay, my value went from 450 to 600, which is, this is the value that I was looking for Coca-Cola to go. Get in, get out, make a couple of dollars, and that's how you make money off of dividends, and that's how you make money off of stock value. Also, you'll see what is called a dividend date. A dividend date simply just means that the date that if you own the stock that day, whether you sell it or not the next day, you will get the payout. You'll get the payout that's here just for owning that stock. All right? And then the dividend payable date will be another date. That means that's the actual date it'll deposit into your brokerage account. Now, different brokerage companies report this differently. So I don't necessarily need you to go by this scale, because if you are like TD Trade or Charles Schwab, they may have a different formula. This right here is from E-Trade. So this is one of the platforms that I use is E-Trade, but they may have different information. My job is just to let you know what it is, the fact that you are looking at when you're looking at one of these, okay? So, now, the next thing, I'm going to look at another stock and why I picked those stocks. So if you notice, I picked 3 different stocks, and I picked 3 different stocks for a reason. The next one is the JCPenney stock. I'm posting about JCPenney a lot, and people always ask me, they say, how do you make money when a company goes bankrupt? You make money when a company goes bankrupt simply because you are really buying and selling to be in and out really, really quickly. It is not designed. I do not encourage, repeat after me, I do not encourage anybody to hold bankrupt stock. I don't care what you think is happening with the company. Your job is to get in and to get out. All right? Now, the JCPenney stock that I put the link to, you'll notice when you look at a stock, how do you know a company is in bankruptcy? You see a good price for a stock, and you say, all right, I may want that stock. Why is that stock price so low? So the JCPenney stock symbol is JCPNQ. This Q lets you know a company is in bankruptcy. All right, this is normally the regular stock. Now, for the most part, I've seen some companies in bankruptcy not have the Q on there, and I just believe that they're probably so big that there's an exception to the rule. But not usually when it's a bigger company. Like another stock that I have, it's a major corporation. I know for a fact that they're in bankruptcy, but their stock is still so strong that they never had a Q in front of their name. I never looked to figure out why, but just letting you know it sometimes happens. But when you do see that Q, you need to double check, make sure that one, that they don't have a funky stock symbol that just Q is part of their name. But this is always a flag when you see that to double check. Okay? Now, I mentioned about when I bought JCPenney stock at 12 cents. I posted about it and I, made some money off of it. So how did I do that? How did it happen? What am I thinking about? What's going on with it? And how do you make money and why I say stay away from it? Because it is what they call very, 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 very volatile. Now, anytime you purchase a stock under $1, when you purchase a stock under $1, is called a penny stock. So when you hear the term penny stock, remember that's any stock under $1. And to purchase a penny stock, you must purchase it by doing what is called a limit order. And a limit order just allows you to put in the specific number as opposed to the regular market order where you just go buy, sell on the market. So most places will require you to put a penny stock. So in this case, when I purchased JCPenney's at 12 cents, and I realized that they were going to, I believe that they were going to go up because I had a specific number that I wanted JCPenney's to go to. So when I bought my stock at 12 cents, what I put in, for example, I'm gonna make these roundabout just so you'll know. I purchased for $1,000, right? No, let me make it simpler. Say $100. So at $100 at 12 cents, when JCPenney's went up to 24 cents, my value was $200. 100 that I originally put in, plus it doubled. All right. When it went to 36 cents, it's essentially tripled. So the 100 I put in plus the 200 I made. Likewise. So it went all the way up to, I think I sold it at 43 cents is where I sold it, which I posted online. So, and that was, let me see. So it went all the way up at a 31 cents difference. So this is 31 cent profit per share. All right. From here, when I purchased it, and this was in a matter of, I think, a week or 2 weeks. I think it was a week. So I went from 12 cents to 31 cents in a week per share. So it's 31 times 100. All right. So in that case, I'm sorry, 31 cents. I'm sorry. Yeah, that's right. 31 times 100. Now, in theory, it's 31 times 100 per share. Um, no, that's wrong. I'm sorry. So what I did, yeah, I'm sorry. That is right. Yeah, 31 cents times, no, I'm missing a number. I apologize. So out of here, I missed a step. Out of the 100, let's do this. So in this case, out of the 100, I was able to get 8 shares. So I forgot to include that number. So here, now I have 31 cents times my original 8 shares times 100. All right, so I messed up, my bad. So 31 times 8 times 100. So my $100 in theory would equivalent me to $248 in profit. This is the difference because I'm still not counting my 12 cents of original investment. So if I personally put in 1,000, obviously you would just add a 0 and that would be your profit. But if you just only had $100, you essentially turned your $100 into $348. That's how you make money off penny stock. A lot of people try to put in way more money. I'm not encouraging you to put in way more money. I'm not trying to encourage you to put in way more money. What I'm trying to encourage you to do is to learn how to invest. I don't want this to go into a situation where you're putting in thousands and thousands and thousands of dollars. What I want you to do, anytime you invest, if you try to invest in a bankrupt stock, then you're going to go and learn the market. You're going to get in, get out. I will understand what's going on in bankruptcy. For the more sophisticated people, they're going to look at the numbers, they're going to look at the court followings, and then they're going to look at everything else. But for the not so sophisticated following, what you're going to do is, just get in, think about when you see this stock at 12, where do you want it to go? Do you want it to go to 24? Do you want it to go to 36? Now I said I just rounded this out to 100, but when I invested, I put in 1,000, and I said to myself, if I double my money, and some of the stuff I wrote on the original post, so you can go look back at that if you care. I said, if this flips from 12 cents to 24 cents, and I double my 1,000 to 2,000, I'll be okay. In this case, I took my 12 and went to 31, and then I actually got my profit of $348, $3,480. So That was the profit how I made it, but I only stuck around for about 2 weeks. Now, the thing about that is this stock ended up going all the way up to $63. Did I lose? Um, did I lose just because I didn't wait for the stock to go up? In my mind, the answer is no, because you don't never know that it's going to go this far. And it actually went up 63 cents, not $63, 63 cents. And just because it was going to go up from here to 63 cents doesn't mean I lost money. What it means is I could have waited longer, but it went from 63 cents from 12, but went all the way back down to 25 cents. So if I bought it at 63 cents and then went back down to 25 cents, obviously I would have lost a lot of money. I would have been screwed. So I never get upset when the stocks continue to keep going up. I just take my profit and I run. Okay? So that's penny stock buying bankruptcy stock. I really don't encourage it. But if you know what you're doing, or if you've learned what you're doing, or you're comfortable with what you're doing, you want to take that risk, go ahead and take it. Because a lot of you ask me, how do I buy or sell or whatever in bankruptcy companies? So that's the buy, sell bankruptcy companies. In and out. Do not put that in your portfolio, or I'm sorry, do not put that in your retirement account whatsoever. I would rather you to wait for that company to come out of bankruptcy if you still like the company, because you never know what's happening. All right. So now, if there's any questions, ask them now. If not, my last one I'm going to do is the oil stock. All right. And that is MRO. Okay. If you understand about oil, you'll know prices are extremely cheap, and there is a reason why. I also like MRO. Last time, the reason why I like MRO was because I've actually had this stock for a while. I've bought it and sold it many times. And so I've traded it many times. And each time I buy MRO, it's because when the market goes low, they are one of the companies that many forecasters believe they'll be around for a while. They've been around for many years. And so I think that they've weathered the storm of low oil prices. So if you also notice, I had another listing of what's called the Wall Street Journal. And the Wall Street Journal, the only reason I put that page in the images that I gave you guys is so that you can check out what is called crude oil pricing. Now, the Wall Street Journal, like today, the crude oil price is $36.56. Now, when I'm showing somebody locally, meaning at my computer, in front of my computer, I usually take them to the Wall Street Journal's pricing, because if you look at the top hand corner, you'll see crude oil pricing. And they're one of the very few people that kind of list it publicly, where you don't have to go hard to find or remember what site it was on. Every day since I've looked on the Wall Street Journal, they've had the crude oil pricing, and so I've always followed that. So that's a good indication. Earlier this year, that was down to maybe about $9 or something. This is not an accurate number, but this is a good number. So earlier this year, MRO, which is one of the companies I actually bought, and I have quite a bit of stock in it, their numbers were down to so as of April 1st, they were at a low of $3. So when they were at a low of $3, I bought this stock because I knew what was happening in the world was two things. One, is that nobody was buying oil because everybody was stuck in the house because of the corona. Two, Saudi Arabia and Russia had a lot of infighting to what is called the OPEC nations. Now the OPEC nations are the world's largest producers of different countries that produce oil, set the price of oil, and things like that. We had in the United States what was called we had a full inventory, which means that basically the oil machines were producing. However, at the end of the day, even though the oil rigs and all of these things were producing oil, there was nobody to sell it to. So inventory got full. A lot of people don't know. There's different parts of the country that keep inventory, and that inventory is not designed to sit. So if you think about it, at some point, if the oil bins, for a simpler term, is being filled or full, then and the machines can't stop running, the price is going to drop low, and they end up having to sell or force or pay people to sell the oil. The oil companies have to sell the oil or pay people to take the oil off their hands. That is one of the reasons MRO's prices and other major oil companies' prices in the crude oil started to drop. Now, what started to happen is I noticed that. I started to listen to the news, the world markets, and things like that. So, as the world started to open, so to speak, after the corona, guess what started to happen? The price today is at $6.58. So, my money has officially doubled. It is over 100% doubled. All right? So, if my money is at 100%, I predict, and I base this prediction off absolutely nothing. But it's speculation, so here I go. My goal is, I'm hoping, I'll make this prediction, that crude oil will go, I'm sorry, not crude oil, the MRO's price will go from either to $9 to $15. Where am I basing that price off? Absolutely nothing. But I just think that there will be a spike because everybody's out driving and things like that. So what I did was I said to myself, where do you think this is going to go? So I put an alert. Let me know when this number here, when I purchased it, gets to 9. Once it gets to 9, I'll just put a simple number because I tell you to get $100. So if my $100 now will turn into $300. My $100 will turn into $300 when this hits 9. So I have what is called a stock alert. And when I do it, I don't necessarily have to sell just because it hits 9. I just need to be alerted. So after it hits 9, I'm going to put what is called a stop on quote behind it. Now, I don't know how other trade brokers work, but again, I use E-Trade. E-Trade allows you to do what is called a stop on quote. And a stop on quote tells me that once this thing hits my number, let's say it hits $10. I get my alert of 9. I am ready to sell. I personally am ready to sell at $9 because that's going to turn my $100 into $300. So I'm ready to sell, but I may not sell. So just in case it goes higher and goes from 9 to 15, I don't necessarily want to sell at 9. So I'm going to put my stop at quote at $9. And you can research what it means. You can go and Google what it means. I'm not going to take the time to do it right now. But I want to do that so it trails my $10. So anything $9 and above, or $9.01 and above, it will not sell my stock. But should I be wrong and this thing comes back down from 9 to 8 to 7, it's going to trigger at 9 to sell my profits because I personally knew this is the number that I wanted. This is the number that I suggested my target goal was. I could be right, I could be wrong, but anytime I get into a stock, I always have a target of what I want that stock to be. If I'm keeping it for a long term, like I talk about the Coca-Cola, that may be a different number. But I personally will still do it with the Coca-Colas of the world because I don't know if, you wake up one morning and they tell you that something crazy happened with the Coca-Cola company. So this is called a stop on quote. You can also do an immediate sell. Let's say for whatever strange reason, the stock is here today at 6:15, and you're on a flight, and some news breaks with MRO that they just hit oil lottery for something, and then their stock all of a sudden jumps to from $6, and it jumps to, let's say, 25. You can do what is called a limit order. And say, this is why the stock is still under whatever your limit order price. You can say, if this stock ever hits, $20, immediately sell it. So that's called a limit order. That means you don't really have to watch the stock. It'll sell. If this $6 jumps to 20, the moment the $20 triggers, because that's what you want out of it, it'll sell. You're not trying to stay in, you're just trying to get the money because there's a surge in the media, and then you can make that profit. Usually when I do limit orders, I don't do limit orders where my target is. I do limit orders when there's bursts in news, because every stock has some day that some news event happened, and it may jump for that one day. And so I always do my limit orders for some extraordinary amount. That way I get to maximize my profits. But I do the stop on quote order so it can sell whatever I believe my bottom number that I want to make a profit is. You can also do this for losses. In other words, if my $3 were to win to $1, I may have had a stop order at $2. So a stop on quote order at $2, that way it's sold for me. All right, so I've been at this for more than an hour. So at the end of the day, if you have any questions, let me know, inbox me. And I know some people say they want to know the difference between ETF stocks and things like that. I'll try to do that next Sunday, bonds and things like that. And if you have any more questions, I'll try to specifically address those questions. Those who have access to me know how to get access to me. So I'll address those too. But hopefully this helped you in understanding stock, why I chose certain stock, how to read some of this stuff, what it means. Again, it's so much information, it's hard to really do this within an hour, but I don't want to bore you. All right, until next Sunday, whatever time, peace.